Good morning, everybody. Karl here. Monday morning, and I hope you are doing well with this in these strange times of working at home and being isolated from almost everybody in our lives. I have a specific agenda for talking to you this morning. The government came out with some new rules last week which relate to your profit sharing account, retirement funds, and making them available in this time of work shortage. These changes in the retirement plan are not available to everybody, only to the companies who take advantage of it, and our company has signed up for it. And it relates in three areas of our profit sharing plan. One is that there is a temporary relief from making loan payments available from now until the end of the year. So you could apply online on your Merrill Lynch account to suspend those payments. Now, here's what happens. It's not just a freebie. You're not making payments between now and the end of the year or any time you choose to resume them before the end of the year, but interest is still accruing. You still owe interest on this money you've borrowed in the past. So that amount will keep kind of going on top of the outstanding loan amount. So let's say at the end of the year, when it's the deadline for resuming payments, your new loan balance will be a little larger, and then the payments will be re-amortized, refigured out on a biweekly basis so that the loan can still be paid off in the same amount of time. So relief number one, kind of a relief now, a little burden later, is that you can stop making loan payments between now and the end of the year. It's not automatic. You have to sign up on the Merrill Lynch website and with Benta, and that's available. The second is they have changed the loan rules for this period between now and the end of the year. The maximum we have been able to borrow from our retirement plans up until now is the smaller amount between half of your vested account and $50,000. So you have your account and you're vested, say, 65%, and then half of that has been available for a loan. Now, under the new rules that are in effect between now and the end of the year, temporary relief, you can borrow up to your full vested amount with and no higher than $100,000. So whichever of those two amounts is less. So your account has this much in it, you're vested 65, you can borrow that 65% with a 5-year loan. And that would be figured out at the current interest rate, which you can play with the numbers. You can actually model the loans on the Merrill Lynch website. Two things so far. So one, suspending loan payments. Two, borrowing a larger amount of money for new loans. The third form of relief now, burden later, what I call relief now, burden later. But if you need the relief and you qualify for it because you have an employer who has cut back your work hours, these rules do not apply to everybody in the nation. They apply to people of the coronavirus itself or caring for a family member who has come down with this form of the flu, and those whose income has been dramatically affected by work cutbacks or being laid off or furloughed. So we fall under that third category. The third item that's available, and I'm trying to keep going here so I don't keep you too long, is that you can withdraw money from your retirement account up to your vested amount and not more than $100,000. This is not a loan that you're paying back. This is a distribution that stays out maybe forever. The good part of it is if you have a financial burden right now, there's funds to make it available. The not so good part, when you have to pay the piper later, is it will be income to you. It will be income to you. You can show it as income on your income tax return over 3 years though. So you could split them out into 3 and add a third of it to your income over the next 3 years and pay the income taxes on it. Now, as you know, there's a 10% penalty for taking out money before you are 59 and a half. And that penalty would also be waived. So again, this is a mixed blessing, but for relief in a time when your finances might be constricted and have trouble maybe making a house payment, you are eligible for taking a distribution, taking money right out of the plan, and then you have to call it income, but you can call it income over a 3-year period. You can also put it back in the plan in 3 parts or all at once in those 3 years to keep it in the tax system. So remember when we talked about long-term money, you think you have this much now, but in 25, 40 years, it's a gargantuan amount more. So, there's a downside to taking it out now and losing the time value of money. But these are strange times, and your finances might be stretched beyond what you think you can handle. So there are those 3 forms of relief that the federal government passed into law last week for getting money, using the money that's in your retirement plans, either to defer your loan payments and between now and the end of the year, borrow more than you could have in the past, up to your vested amount or $100,000, whichever is less, or outright take a distribution from the plan, which would be income to you, but there'd be no extra 10% penalty. And that income could be split over 3 years, and those funds could be put back into the plan to regain their tax-protected status between now and retirement. If you have any questions, give me a call. The email that this link is in also has it spelled out, as well as an attachment from Merrill Lynch that outlines these 3 things as well. Hey, we're going to get through this. It's going to take, it affects us all. And so we need to stand alongside each other, and I hope you are being good to each other. And let me know if you need anything.